Thank you. Good morning, colleagues. Good morning. Happy New Year to all of you. And I hope this is a year that will push us to greater strength. From strength to strength, we need to move. Um, and today we will cover the standard presentation in terms of the discussion that took place yesterday, the Monetary Policy Committee. And after that, we will, as well as just told us, open it to Q&As. So in general, the inflation remains stable and within the range, our target range. And this is despite significant increases in the food prices. This went up by about 9% in December. And again, it's the standard products that we talked about last time: tomatoes, onions, and then, of course, maize and maize flour. All those, obviously, or some of them are, at least the tomatoes, onions, and things like that, are being driven by the excess rain that we have been seeing. And we know what has been happening with maybe we don't know what has been happening in the maize sector. We know that is a significant sector. There are problems in that sector, as has been mentioned recently by the president, and obviously you are well acquainted with those things. Non-food, non-fuel inflation remains below 3%, low and stable. So inflation expectations are well anchored. As a matter of fact, the survey that we undertook, the MPC survey, the respondents flagged the continued rains and potential harvest losses as the concern. So exactly as I have mentioned in terms of tomatoes, onions, and other products like that. Global economic outlook. This is looking worse by the month. The IMF revised its forecast earlier actually a week ago, on Monday, on the 20th, and lowering their estimate of global growth in 2019 and also the forecast for 2020. Both were lowered by 0.1 percentage points, and therefore the growth estimate for 2019 is 2.9%, and in 2020, 3.3%. Frankly, this is the worst outcome, that is the outcome of 2019. The worst outcome in global growth since 2009. 2009, we had minus 0.1. And then before that, you have to go to 2001 to get 2.5%. So you can see things, no matter how you slice it, things are not looking great in the global economy. Now, there is obviously some positive sentiments that was injected into the economy earlier this month because of the conclusion, or should we call it the Phase 1 agreement between the United States and China. This is, if you will recall, was related to their trade war, or the disagreement that they were having on trade. And so they did get an agreement which was signed, and that was so-called the Phase 1. There are other things that still need to be dealt with. But that obviously injected a sense of optimism, because the sense before that was there may not be a conclusion. But be that as it may, there has also been significant downside risks that remain prominent. And this include, of course, the continuation of more trade wars between the US and China, the geopolitical tensions that we have seen, Iran and other places like that. Brexit has still yet to be resolved. Yes, there'll be something later this month. So we are talking the end of this week. But still, there are significant uncertainties around it. and other factors, including even the stance of monetary policy in the advanced economies. All these mean that there's, or they have, they, they indicate, or they continue to show significant downside risks. On top of that, there's one other issue, which is the outbreak of the coronavirus in Wuhan, China. We all know what has happened there, and obviously there's a significant human cost to it and the human life. But beyond that, there is the concern in terms of the economic impact of that. That's the containment, the measures to contain the virus. So basically, in one sentence, there are many uncertainties and also potential triggers to a significant, let's say, downturn in a rather fragile economy as we see it at the moment. As a matter of fact, just yesterday, in the advanced economies, and in particular the New York stock market, and indeed the New York markets, they actually, they took a hit. In a sense, there was a sense of a correction, mainly driven by the reaction to the corona virus, that the news about that, and actually that some people had been, or there were people in various cities in the US, that in particular Chicago, but other places as well, that had come down with this virus. So a lot of negative reaction in the markets to this. So that's the global economic outlook. Not good, but at this moment, a lot of risks. What about Kenya then? Kenya, the external sector. The external sector remains or continues to improve. The current account deficit is estimated in 2019 at 4.6% of GDP, which is lower than the 5% that was recorded in 2018. Now, if you look at the details of the balance of payments, what you see is that in 2019, it reveals that exports as a share of GDP, so if you measure things as a share relative to GDP, exports fell, but imports fell even more. So it's important to see that. Now we are talking obviously as shares of GDP. So in terms of exports, as a share of GDP fell by something like 0.8 percentage points, and imports fell by 1.7 percentage points of GDP, that is. Basically, that's how we ended up having a contraction in the deficit of the current account. I don't want to go into the details of exports and imports and so forth, but suffices to say on the export side, tea and horticulture have not been doing too well towards the end of the year. At the beginning of the year, they were doing well, but towards the end of 2019, they weren't so hot. Imports, on the other hand, have continued to contract, largely driven by the reduction in SGR-related imports with the completion of that project, at least the large imports related to that project. Remittances hit an all-time record. This is at, the number is 2 billion 7, well, let's just say 2788 million. How is that? 2788 million. US dollars. That is the amount of remittances, our estimate of remittances in 2019, and this is actually about 50% of merchandise exports. I mean, by far and away the largest sources of our inflows is now remittances. Now, I want to also mention that we have, the foreign the current account deficit has been fully financed, FDI, and also portfolio investment. And I think it is important to mention that actually FDI has come back. There was if you look at, say, over the last 15 years, around 2007, there was a surge in FDI. And that surge related to specific projects that were being undertaken. For instance, the investments in the geothermal projects, windmill, and things like that. So there was a lot of inflow in FDI to deal with those large projects. That, and also, should we say, the oil exploration, a lot of large investments to deal with that. But then it has come down from that rather unusual level. It has come down in terms of percentage of GDP back to a level like 2% of GDP. And that's where we are. So we are around 2% of GDP, and that is partly financing the current account deficit, which we mentioned a moment ago, of 4.6% of GDP. I think that's the number I mentioned. So FDI continues to come. I think it is important to also talk about the diversity of FDI. It is quite diverse. And I think here is a case, there is actually an interesting story about where the FDI is coming from. By the way, if one thinks of all the trips that take place or all the conversations that maybe we have, yourselves included, with foreign investors, I mean, a lot of it would be coming as foreign direct investment for many reasons. But there is also the portfolio investment. This is investment, say, in our government securities, or for that matter, in a stock exchange and things like that. And that is also coming. What is interesting is that actually it's quite likely that you'll see a larger and larger proportion of diaspora ending up, investing in our securities, meaning it will be coming in, since they are, even though they have a Kenyan passport, their jurisdiction is outside this country. So that will be coming in as portfolio investment. And so don't be surprised with time to have not so much a decline in remittances, but a stabilization in remittances, but an increase in FDI that is related to people we know. Meaning, instead of them sending remittances, they will be putting investments in the government securities. It's a dynamic that we want to see this year, but it is something that already we can see. We can see it in nascent form. One other thing I wanted to mention about exports and trade is just to give you two numbers. This is with regard to the direction of trade. So the East African Community trade, this is exports to the rest of the East African Community, accounted for 23.4% in 2019. So you can see we are very local in that sense. And then we have, for Africa, the rest of Africa, I think this is sub-Saharan Africa, accounted for about 37.5%. So the point here is to stress the regional orientation of our trade. This is important going forward, particularly when you're talking of the African continental free trade area. This is important. And also you can see it has a stabilizing effect. The rest of the world may, if there are problems in the rest of the world, at least around us, there's some stability. And therefore, we won't have as much concern as if, for instance, 90% of our exports were going to a particular country or were going to the advanced economies or something like that. But I wanted to tell you that because, in a sense, it offers a sense of security because of the diversification that we have. Obviously, it doesn't mean that we should rest on our laurels. Of course not. But it is important to see where our risks are and maybe where our strengths also are. So, bottom line, foreign exchange market remains stable. I've talked about the contraction in current account, and the flows, they are very balanced. And we expect that this will remain stable in 2020, when we expect the deficit to be, the current account deficit to be around 4.7% of GDP. I think I have explained it a lot now, severally, that actually the current account deficit of around 5% of GDP is, I want to call it a sweet spot. You know, it's more or less where you could say, yeah, that's a good place for us to be as Kenya. Okay, let's move on to other things. As you all know, in any of these things, we could talk virtually all day about any of these things, so it's better to move on. Banking sector, this remains resilient and stable. Liquidity risks continue to ease, and obviously there's better distribution of liquidity in the sector. Also, credit risk is easing. NPLs to loan ratio has fallen to 12% in December, from 12.3 in October and 12.6 in August last year. And almost half of this decline has been due to write-offs, or rather it has been 50-50, split between write-offs and also recoveries. So you can see there has been, let's say, there's been fruit, there's been, the banks have really gone on an aggressive campaign, aggressive recovery, right? And been working on that, and you can see it's bearing fruit in this regard. Now I'll talk later about, well, maybe I should mention also with regard to operational risks, this is something that we have been very much, let's say, aware of, and banks also, commercial banks have been alert, particularly now you're talking things like cybersecurity or other things. By the way, you know, around December, that's when you have a surge in, sort of cyber crime and things like that. For the same reason that you also have a surge in house burglary around that time. The banks obviously are wiser, and or they have wisened up, and we are not just talking Kenya, we are talking around the world. And so they too, just like yourself, that is when you set up your house alarms and whatever it is, and therefore you minimize that risk that would otherwise have been come to pass. We'll talk about other things in the sector, but I think it is important to mention that there's a lot of transformation that is taking place in the sector. And I think for those of us that, let's say, are impatient, then maybe this is not the job for them, because the transformation is not about a single iconic moment where you can say, yes, this is the mark that, let's say, characterizes the transformation. There's a lot of hard work, a lot of grind. So for instance, in the interest rate, post-interest rate regime, we've made the point that there has been significant transformation. So in the post-interest rate caps regime, obviously we have been working with banks even before, trying to explain to them and actually working with them to understand what still remains for them, so as they can move to the next level, the transformation that we have talked about in our economy. By the way, we did write an op-ed piece that some of you published, but if you haven't seen it, it is on our website. And it is all about, why this time it's different. Why is it different this time? Meaning, Why is it that we do not expect, after lifting of the caps, that banks will go back to the same old, Wild West sort of maneuvering? And I think even though I say it myself, I think we explain it well. What is it that we are saying? But what is clear is that we have been working with each of the banks, and we have been working in the context of the banking sector charter, and they have to come up with a plan, indeed even make presentations to us, but also have agreement and presentations to all levels of the bank, meaning including to their board. And the point is that, which is the issue I want to stress, we do not expect some sort of random, let's say, model, where they say, okay, this is for instance, how is it that they are going to assess that this individual has a certain risk profile? I mean, it cannot be a random number. It cannot be a random, let's say, model that does that. So it has to be a robust model. So we don't want just to throw it back into a black box. I hope we understand what this is. This is important because that's really where everything will stand or fall. And that's why we need to work with them to be sure that they have a robust, let's say, model, a robust mechanism that actually delivers what they claim, or what all of us in this room and everywhere else, indeed every single Kenyan, wants. I've given the example of the chicken farming. I definitely need to be more risky, more risky in a sense in terms of chicken farming. But maybe a chicken farmer should actually be assessed at a lower risk. And the model should be able to deal with that. You understand? And that's really the point. So we've been working with them. But in terms of the details, I'll just say that so far we are content in terms of the progress we are making with the banks. And I'm sure that customers also should be content with the progress that, or indeed how things, the evolution of the evolution in the banking sector. That's what I want to say for now about that. Talking about transformations in the sector, I would also say that there has been significant consolidation, and you've seen some of the numbers, some of the announcements. Actually, in my last count, I have 8. So I don't know if you have 8 in your count, but I have 8. So if you don't know the 8, then later on I could tell you. The most recent ones were KCB and NBK that we know. Then even more recently, there was the CBA and NIC. And then the last one that was announced most recently is Access of Nigeria acquiring Transnational Bank here in Kenya. So those are the last ones, but that's number 6, 7, and 8. If you are missing the first 5, then I could tell you that later. But it is interesting to note again that it's not a single iconic moment. It is actually a lot of work that actually happens. And the announcement is really the final, it's really that, an announcement of a successful consolidation, should we say a merger or acquisition and things like that. Okay, let's move on to the other items. I'll say very little about the MPC survey. It was there, but I don't want to, here I think you'll see a lot more when the document is published, except to say inflation is well anchored. At least that is one of the respondents did indicate that in their responses. And there's still a lot of optimism. Actually, the level of optimism has not changed since November. So banks are 92% optimistic or very optimistic, and as for non-banks, 72% are optimistic or very optimistic about the outcome of the economy, meaning looking forward. Now I want to mention a few things that I generally don't in most presentations. So this is the surprise part of the presentation. First, I want to say a few things about fiscal, the fiscal developments, and I would point you to the details that are available in the budget. It's called BROP. I don't know what it means. So somebody can tell you what BROP is. B-R-O-P. It's budget something paper. Budget what? Okay, so whatever. BROP. There are some things that somehow register in acronyms and you don't know what it means. And this for me is one of them. But it is available on the National Treasury's website. And it indicates a few things, but I'll just summarize some things. Not all of them, but just highlight some things. First, in terms of revenues to December. The number there, they collected 920.6 billion against a target of 1,059.3 billion. Now, that obviously is below target. However, remember they were starting from let's say a very bad situation. So even as it is below target, the growth has grown by about 16%, which last year, we're now talking just the first 6 months. Last year it grew by only 12%. So you can see at least now they are catching. So you could say in nominal terms, meaning as a share of GDP, they are catching up, right? So as a matter of fact, as a share of GDP, it is 8.9% of GDP relative to 7.7% of GDP last year. So I just want to point some things. Even as we mark them against the target, there has been improvement against those targets, but also against what happened before, based on where they were starting. So this is the equivalent story of, we needed to talk about marathon running and things like that. This is the equivalent of somebody who has not been trained, who starts training for a marathon or any of these things. Obviously, when you start, you cannot even finish 10K. But with time, you begin to finish 10K, and it begins to feel okay. And so you can, eventually, you will get to finishing the marathon. So it's that direction. The direction is right. And the numbers are moving in the right direction. And this isn't just a sort of a slight blip in the needle. Yeah? I mean, a movement of over 1% of GDP is significant. So that is important. Expenditures obviously were below target, correspondingly by something like 163 billion. These are Kenya shillings. And this was both in the recurrent and the development budget. Disbursement to counties was 122 billion, of which 112 was part of the equitable share, and the rest of it, 10 billion, was for expenditure, national government expenditures that the counties are actually undertaking on behalf of the national government. So, what is their target for deficit in 1920? So this fiscal year, that is 6.3, and the MPC members looked at the details of this, the presentation, and it, as we said last time, it was credible that in terms of how they are moving, that they could achieve something around this number. So this would be a reduction in the deficit from, or should we say a contraction, from 7.7% of GDP that happened, that was the actual last year. So from 7.7% to 6.3% of GDP. And for 2021, that's the next fiscal year, they are hoping to have a number like 4.9% of GDP. And that is also in the prompt. So that's where we are. Now, pending bills. This also was a big issue last time. And we also had a detailed discussion of pending bills. And I think one can understand why, because it has an impact on the economy. It also has an impact on liquidity. So it is important to be clear as to where this is. And we looked at the numbers, but I want to give you some broad sort of directions here. First, in terms of the national government has virtually cleared all its pending bills. Okay? And these are the current ones we are talking current. It's true there are some historical pending bills which are being looked at by a multi-agency team. So a team that has been assigned specifically to go look at the old historical things, because you never know, there could be a lot of maneno in those things. So a team of people need to look at. But in terms of the current ones, the National Treasury has over the last 6 months dealt with those. So if there's anything, it's insignificant in terms of numbers or size or whatever. As for the counties, the Office of the Auditor General looked at what was presented to it as 88 point, this is an interesting number, 88.98 billion, pending bills, of which they reported 51.3 billion were payable. So of the 88, they separated that, and there are 51.3 were payable, and the others didn't have the necessary things to assure and to confirm to the OAG that these were truly pending bills. Anyway, those also will be dealt with. But of this 51.3, of this payable amount, 30.3 were paid by January 23rd, which is, today is just a few days ago, right? So you can see there has been significant progress. The rest of it, the difference between 51 and 30, that also they are looking at. I mean, the counties are looking at those numbers or those pending bills. And a lot of them have formed committees to figure out whether these are truly pending bills and eventually have them paid appropriately. So, bottom line here, there has been progress in the pending bills. We in the central bank have seen the numbers, have seen the payments coming through, because you can see the liquidity injections and things like that. And also, in some sense, as we did in last year in June, more like July, after the substantial payments, you can tell that there is some sort of stability and noise level falls. As a matter of fact, how you find out about this is through repayment of loans. So a lot of these people probably had loans, and you see that they're making good some of their payments. So I'm just pointing some general direction. We're about to finish. So the last part is where we therefore on output, GDP. And Q1 to Q3 data, we have that already. We got the Q3 data at the end of December. And using the leading indicators for Q4 2019, we estimate GDP growth in 2019 as something like 5.7%. So 5 3/4. And also, again, project 2020 to be around 6.2. frankly, this is a very benign baseline, 6.2. We've talked before, we've mentioned, we've made the point that there is substantial upside because of the output gap, but also because of the significant potential that still remains in terms of investments and things like that. Not just, when you talk output gap, you generally mean investments that are in place and people that are, so machines and things that can produce stuff, agriculture farms that can produce things. You're not talking of additional investments, say over time. That is, that would increase, let's say, your production possibilities. So even with a very benign sort of projection, we'll end up at 6.2, as we have mentioned. But the point is that these numbers, beneath them or inside them, there are some concerns that could probably lead, if they are dealt with, would lead to a substantial increase in the output. So, for instance, agriculture in 2019 was weaker than we were expecting. That is significant. And we have the 4.6. We have a 4.6 growth in 2019, which, frankly, is below the average over the last. I think the average of if you ignore 2019, begin with 2018 and do 5 years, it would be around 5%. So the point is, this is still below the average. And I think we understand why, some of the sector problems that we are talking about. That said, there has been some policy pronouncements, and in particular, His Excellency the President spoke on Tuesday, January 14th, and made specific policy pronouncements. And I want to flag 2 areas. One, in agriculture. There's a lot of action, a lot of policies in tea, coffee, milk, perishables. There was also action in terms of maize, but the ones that at least you could say there was significant movement were these ones that I just mentioned. There's also pronouncement in the area of micro and small and medium-sized enterprises. And the point is that if these actually are implemented, the issue for us is always implementation. So if we implement things correctly, then you can see a substantial improvement in these sectors will be reformed, will be transformed. And that would obviously lead to a significant increase in the GDP. But still, we haven't loaded that into the benign projection that I mentioned a moment ago. So, output gap, we estimated that there was still a residual output gap, and there were minimal risks to inflation going forward. As I mentioned, inflation was well anchored. Then we looked at the policy action that we took back in November, the reduction in the CBR rate by 50 basis points, and we assessed that this was still working through the economy. It takes about 4 months, or a minimum of 4 months, for a change in the interest rates in a perfect world. Or maybe I should backtrack. We actually did look at estimates that were done about the transmission, the evolution of such a shock, right, or such a policy action. The peak impact is something in 2 months. It's around 2 months. So the November action, if you think of it, it was at the end of November. So actually, it is about now that it would really be kicking in, right? And it's still transmitting itself. So that was one thing. Secondly, there was the fiscal withdrawal, which I mentioned, and this is one of the reasons I needed to belabor it and sort of say, yes, there is actually a lot of action in consolidating fiscal. And thirdly, also weigh into this or throw into the mix the policy actions that I mentioned a moment ago that were aimed at re-energizing agriculture and medium and small size, well, micro, small, and medium-sized enterprises. So on this, taking all these things together and also assessing the output gap that was there, the Monetary Policy Committee decided on a 25 basis point cut in the CBI, and that is what was announced in the papers.